All right, so let's just start with a scenario. Imagine this, and, chances are you or someone you know has been in this exact spot.
Mm-hmm.
An unexpected emergency just hits. The furnace breaks, maybe a medical bill lands on the counter, and you need cash
Right, and not just cash, but cash immediately.
immediately. You don't have time for a bank loan,
Mhm.
and let's be honest, your credit score might not even get you in the door anyway.
No, probably not.
So you need a fast fix, something
Yeah.
you can get in, say, 15 minutes, maybe for just $100.
It sounds like a lifeline.
It sounds like a perfect solution, but here is the monumental catch. The collateral for that cash, it's not some jewelry or your next paycheck.
No.
It's the one physical asset that basically dictates your ability to keep a job, to live your life. It's your vehicle.
And that's the high-stakes trade-off we're diving into today. We are exploring the world of the car title loan.
It's a financial product that seems to offer speed and access
Mhm.
when, all the traditional doors are shut.
Exactly. But its whole structure has created this decades-long firestorm of criticism about the true costs, the risk, and the often devastating impact it has on the very consumers who rely on it.
So our mission in this deep dive is to give you a really comprehensive but quick understanding of this whole alternative financial world.
Mm-hmm.
We're going to dissect the core mechanics of how these secured loans work, trace their history, which is surprisingly recent, and really scrutinize the economics behind them.
Especially those extremely high triple-digit interest rates that fuel the whole industry.
Yeah, and we're going to distill the arguments from consumer groups who say this isn't a safety net at all. They say it's more like a sophisticated financial trap.
So to set the baseline, we have to start with the basic definition. A title loan is, at its heart, a type of secured loan.
Secured, okay.
The borrower uses the title to their vehicle, a car, a truck, sometimes even a motorcycle, as collateral.
And this is more than just a promise to pay, right?
Oh, much more. The lender places a legal lien on that title, effective immediately, and the borrower has to physically hand over the hard copy of the title for the cash.
And the deal is, what? Pay it back, you get your title back.
That's the simple pitch. Repay the principal and all the interest that's piled up, and the lien is removed. The title is returned.
Okay, so let's unpack that distinction. Secured versus unsecured credit, because that seems to define the entire risk
It
here.
absolutely does.
So when we talk about unsecured credit, that's like a standard credit card, right? Or a personal loan from a bank.
Exactly. It's based on your credit history, your perceived trustworthiness. If you default.
Your credit score gets destroyed, you get collection calls, but they can't come and take your couch.
Right. No physical asset is seized. A title loan, on the other hand, is firmly in that secured category.
So it's more like a mortgage.
It has a lot in common with a mortgage or even a traditional pawn loan. But the collateral here isn't a house, it's a depreciating asset that you need every single day.
For transportation.
And that risk is profound. The lender has a legal claim on the physical object. You default, you lose the car.
And that secured status is what allows them to move so fast.
That's it.
If they're holding the title to your $10,000 car, they don't really need to care about your financial history.
Precisely. That's the key trade-off. Because the loan is backed by that physical asset, the lenders, they just minimize the need for any real underwriting or credit checks.
They don't care about your past. They care about the car's present value.
Exactly. Its current market value. And so, the immediate benefit for someone in a crisis is access to cash, no matter their credit score.
But the downside?
The downside is equally powerful and potentially devastating. Losing your car can mean losing your job, and from there, you just descend into an even deeper financial crisis.
So let's jump right into the transaction itself. How does it actually work? Let's start with those two things that define the industry, speed and that very low barrier to entry.
The speed really can't be overstated. When you walk into a title loan store or you fill out the application online, the whole process is just engineered for immediacy.
15 minutes, you said.
Most loans are done, start to finish, in 15 minutes or less. This is what sets them apart from almost every other form of credit.
Right. If you're facing eviction tomorrow, you can't wait 3 to 5 days for a bank to maybe approve you.
It's just not an option.
And the loan amounts are so small, too. That's what's so counterintuitive. We're talking as little as $100.
It's liquidity for micro emergencies. That's not a huge capital investment for the lender. It's just enough to cover a broken water heater or get your utilities turned back on.
And a traditional bank just won't do that.
No, think about it. For a big bank, a loan under, say, $1,000 is just not profitable.
Too much overhead.
Way too much. The underwriting, the compliance costs, to lend you $500, it's just a losing proposition for them unless you have perfect credit.
So the title loan companies found a way to make that work.
They bypass that whole inefficiency. By securing the loan with collateral and charging, well, exceptionally high interest rates, they've made these small dollar high-risk loans an extremely profitable business model.
Okay, so let's talk about the requirements. If they're not pulling a credit check, what's on the checklist for the borrower?
It's a very specific list, and it's all focused on verifying you are who you say you are and that you own the collateral.
So an ID, obviously.
A valid government-issued ID, a driver's license. They need proof of income, or at least some regular source of money coming in.
Like a pay stub.
A pay stub, maybe proof of Social Security, something to show you can at least service the interest. They'll want proof of residency, too, like a piece of mail.
But the real gatekeeper here is the car itself and the paperwork that goes with it.
That's the absolute core of it.
Yeah.
You need the car registration, obviously, but the non-negotiable requirement is a lien-free car title in your name.
Lien-free, so the car has to be completely paid off.
100%. If you're still making payments, if another bank has a claim on that vehicle, you cannot get a title loan. You must own it outright.
That right there, that tells you so much about the demographic. You own a major asset, free and clear, but you're still so financially strapped, you need a few $100s.
It's a huge indicator of severe liquidity problems.
A major disconnect between assets and cash.
It is. And there's often one more layer of protection for the lender.
Which is?
Insurance. A lot of lenders will require you to have full, comprehensive insurance coverage on the car for the entire loan period.
Okay, so if I drive off the lot and immediately get in an accident.
And total the car, the insurance payout guarantees the lender still gets their money back. It ensures the collateral is valuable no matter what happens to it.
Smart. Okay, so the requirements are met. We know it's fast. Now for the big question. How much cash do you actually walk away with? It's never the full value of the car.
Never. Not even close. The maximum loan is based entirely on the vehicle's resale value.
How do they figure that out?
They use the industry standards, Kelley Blue Book and ADA guides, to find the wholesale or auction value.
So let's run a quick hypothetical. I have a clean title on, say, a 7-year-old sedan. Kelley Blue Book says it's worth $10,000 retail. What am I getting?
Okay, so in that scenario, the lender is not giving you anywhere near $10,000. The source material is really clear on this. A typical loan is only for 30 to 50% of that resale value.
30 to 50%. So on my $10,000 car, I'm maybe getting $3,000 to $5,000.
Exactly, somewhere in that range.
That seems like a massive gap. Why so low? Why not offer, $8,000? What's the purpose of that huge cushion?
That cushion is the absolute foundation of their business model. Their whole calculation is about minimizing their risk and guaranteeing a profit if you default.
Not if you repay successfully, but if you default.
Right. Their profit is guaranteed in the worst-case scenario. So let's say they loan you $4,000 on your $10,000 car. If you default, what do they have to do?
They have to repossess it.
Repossess it, transport it, store it, and then eventually sell it at an auction.
And all of that costs money.
It costs a lot of money,
Yeah.
and it takes time. Repossession fees, storage fees, auction fees. That could be over $1,000 right there. Plus, the car is depreciating the whole time.
So by the time they sell it, it might not be worth $10,000 anymore.
Exactly. At auction, they might only get, say, $6,000 for it. Now, if they had loaned you $8,000, they'd actually lose money.
But because they only loaned $4,000.
By capping the loan at $4,000, even after all those costs, they easily recoup their principal and still walk away with a healthy profit from selling the asset. That 30 to 50% ratio is their insurance policy.
Okay, that explains their risk management. So now we have to shift to the price side of it, and this is where it gets, well, really alarming. This is the cost of that quick credit.
Yeah, we're moving way outside the realm of conventional finance now. When we talk about title loan interest rates, we are almost always talking about triple digits. Almost always. Depending on the state and its regulations, rates might start at 36% APR, which is already considered the absolute ceiling for responsible lending, and they just skyrocket from there. Well over 100% APR is common.
I think we need to put that into real dollars because a number like 300% APR, it sounds terrifying, but it's also abstract. What does that actually mean for a borrower in a given month?
Okay, let's use an example from our sources. New Hampshire had a law that allowed lenders to charge 25% interest per month.
25% a month.
Per month. If you annualize that, you're at 300% APR.
So let's use that number. Let's say a borrower needs a modest but urgent $1,500 loan. They take out a title loan. What do they owe 30 days later?
At 25% per month, on that $1,500 loan, the borrower owes $375 just in interest.
Little $175.
Just in interest. That's the payment they have to make simply to keep the loan current and not default.
And what about the original $1,500? The principal.
It often remains completely untouched. If the borrower can only scrape together that interest payment, the $375, they've met their obligation for the month. But their debt hasn't gone down by a single penny.
They've just paid for the privilege of borrowing the money for another 30 days.
That's it. And this structure leads us right to the most destructive part of this whole model, the repayment structure, and specifically the balloon payment.
The balloon payment.
So these are short-term loans, 30, maybe 60 days. At the end of that term, the full outstanding amount, that $1,500 in principal, is due all at once in a single lump sum.
The balloon.
That's the balloon payment. And you have to ask yourself, if the person could afford to pay, $1,875 in one go, would they have needed this loan in the first place?
Probably not. It almost seems like it's designed to guarantee the borrower can't make that final payment.
It is, and that's what fuels the debt cycle. That's what leads to the rollover.
The rollover.
When the borrower can't make that balloon payment, the lender offers them a solution. They let them roll the balance over.
Which means what exactly?
It essentially means they take out a new title loan to pay off the old one, often with new fees and a whole new round of interest starting on that same principal.
And this can just go on and on.
It can turn a short-term emergency fix into a long-term, incredibly high-cost debt. Now, government regulation does try to step in here.
How so?
Many states have laws that limit the number of times you can roll over a loan with the same lender to try and prevent this exact kind of perpetual debt trap. But as we'll see, the industry is very good at finding ways around those rules.
Okay, now let's talk about the ultimate nightmare scenario.
Yeah.
Repossession. The moment the borrower defaults.
If you fail to meet the contract, the lender has the legal right to take your vehicle. But what's really interesting here from a business perspective is that repossession is generally their last resort.
That seems backwards. The whole loan is secured by the car. Why wouldn't they want to seize it immediately?
Because it's messy and it's expensive for them. We just talked about those costs, repo man, storage, auction fees.
It eats into their profit.
It eats heavily into their profit margin. Their ideal outcome, their most profitable outcome, is for the consumer to just keep paying that high interest month after month. Repossession is a logistical headache.
So it's not that they want the car. It's that they want the threat of taking the car.
That's the leverage. The threat of losing your transportation is what keeps that debt cycle spinning. But if it does come to that, there are some state requirements to protect the borrower.
Protections after the car is already gone.
Yes.
Yeah.
In many states, the lender has to hold the vehicle for a grace period, often 30 days. It gives the borrower one last chance to come up with the full balance and get it back.
And what if they can't? And the car gets sold?
If the car is sold at auction, the law says that any money from the sale that's over the amount of the loan, minus all the fees, has to be returned to the borrower.
So on that $10,000 car, if they sell it for $6,000 and the borrower only owed $4,000, they should get $2,000 back.
In theory, yes. But with all the fees they tack on and how the loans are structured to begin with, borrowers often see very little, if anything, back.
Before we move on, we should quickly touch on a variation of this, the car title pawn.
Right, the auto pawn. It's slightly different and in some ways even more extreme.
How does that one work?
In that model, the borrower hands over the title and the physical car right at the beginning.
So they give them the keys.
They give them the keys. The lender stores the car for the entire loan period.
And the implication of that for the borrower must be huge.
Well, because the lender has the asset in their possession, their risk is basically zero. So they might offer a slightly higher loan amount.
You lose your car immediately.
You lose your car immediately. So you get the cash, but you've just created a brand new massive crisis for yourself. How do you get to work tomorrow? It's a disaster for most people.
Yeah. It's important to get some context here. This wasn't always a thing, right? This kind of loan.
No, not at all. They really started to become widespread in the early 1990s.
What happened then?
It was a period of significant deregulation of state lending laws, and it happened right alongside the rise of the payday loan industry.
The unsecured cousin.
The unsecured cousin,
Yeah.
exactly. Title loans basically just took that payday model and solved the lender's risk problem by demanding collateral. And it opened up this huge new market for people with bad credit who had been totally shut out before.
So they filled a void that the big banks left open. Now let's talk about the person using these services. The small dollar credit, or SDC, consumer.
Right. There was a big study back in 2012 by the Center for Financial Services Innovation that painted a really clear picture of this demographic.
And what did it find?
It found some common markers. Generally, SDC consumers report lower levels of education. They tend to have more children, so higher costs.
And geographically.
Heavily concentrated in the South, which traditionally has a higher number of unbanked or underbanked people.
So people who are already operating outside the mainstream financial system.
Exactly. Using check cashing services, prepaid debit cards, that sort of thing.
So that seems to confirm the stereotype, right? That these services are for the financially marginalized.
It does, but here's where the source material throws a real wrench in that idea. There's a surprising detail in there about income.
Oh.
It really challenges that narrative of just uniform poverty. The study showed that 20% of SDC consumers reported a household income between $50,000 and $75,000.
Wait, really? 50 to 75,000 a year.
That's right.
In many parts of the country, that's a solid middle-class income. So why on earth are they turning to a 300% APR loan? What does that tell us?
It tells us that income does not equal liquidity or stability. They might have a decent paycheck, but they are incredibly cash poor.
Why, though? What's happening?
It could be a number of things. High cost of living, maybe crippling student loan debt, medical bills, the financial fallout from a recent job loss.
So they have an asset, the paid-off car, but zero savings for an emergency.
That's it, exactly. They're asset-rich and liquidity-poor. And their self-perception reflects this. This is a crucial psychological insight. Even though 20% were earning up to $75,000, 45% of all the respondents in the survey still describe themselves as poor.
So they feel poor, regardless of their income.
They feel vulnerable, and that feeling of vulnerability is what drives them to accept these massive risks just to get immediate cash.
And how they access these loans has changed a lot since the 90s.
Oh, dramatically. The internet has been a complete game changer.
It's not just the storefronts on the corner anymore.
No, it used to be entirely brick and mortar. Now, almost every major title loan company has a big online presence. You can get pre-approved, sometimes fully approved, just by uploading your information.
Your ID, proof of insurance, and I assume the car's VIN, the vehicle identification number.
Exactly. With the VIN, they can instantly run the vehicle's history, check its value, make sure it's not stolen. It massively speeds up that valuation process.
But the transaction usually still has a physical component, right?
Yes, the source material notes that. Even if you get approved online, you usually still have to go to a physical store or maybe a partner check cashing place to actually pick up the money.
Why that last step?
A few reasons. One, it lets them physically inspect the car to make sure it matches the application, prevents fraud.
And two,
that's usually where you sign the final papers and physically hand over the hard copy of the title. That's the moment the deal becomes real and they hand you a check.
okay, so we've laid out the mechanics, the market. Now we get to the core of the controversy. For years, consumer advocates have basically condemned this entire industry. They argue it's not a financial service, it's predatory lending.
The condemnation is aimed right at the business model's incentives. The critics say these companies are not in the business of offering solutions. They're in the business of actively seeking out vulnerable people and trapping them with, and I quote, ridiculous interest rates.
And it's not just the high cost. It's a perceived lack of transparency, too.
That's a huge point of contention. The argument is that lenders confuse borrowers about the true cost, especially the APR, and how likely a rollover is.
You come in just thinking about the $500 you need right now.
Right. You're not thinking about the cumulative cost of that loan after 4 rollovers at 300% APR. By the time you get it, you're so deep in the cycle, your only options are to pay it all off, which you can't, or lose your car.
When you see those triple-digit numbers, you can understand why it gets compared to illegal loan sharking.
The comparison is almost unavoidable for these advocacy groups because the rates are just so far outside the bounds of any other regulated credit product.
And they say the debt cycle itself is the evidence, the smoking gun, for this entrapment argument.
Exactly. Groups like the Texas Fair Lending Alliance, they have data on payday loans, the title loan's cousin, showing 75% of them are taken out within 2 weeks of the last one.
To fill the hole that the last loan payment created.
The loan itself becomes the next financial emergency. And we see this confirmed specifically for title loans, too.
There's research on that.
Yes, a pivotal 2007 study from the Center for Responsible Lending. They looked at borrowers in Chicago, and they found that 20% of title loan borrowers took out a new loan to repay the previous loan to the exact same lender.
So it's a feedback loop.
It's a feedback loop. It confirms that the profit model is built on repeat trapped business, not on people successfully paying off their debt in 30 days.
And if they can't keep up, they face that catastrophic risk of losing their car. Do we have hard numbers on how often that happens?
We do, and they're pretty sobering. The Pew Charitable Trusts tracked data on the 2 million-plus consumers who get these loans every year.
Yes.
They're finding 1 out of every 9 defaults.
1 in 9. Wow.
Now, not every default ends in repossession, but the loss of the vehicle happens to about 5 to 9% of those borrowers who default.
So we're talking tens of thousands of people every single year losing their only way to get to work.
Losing their job, their access to medical care, to child care. It's a financial loss that becomes a life stability catastrophe.
So what does this all mean for regulators? Because it seems like despite all this, regulating these practices is incredibly difficult.
It's a high-stakes game of whack-a-mole. State legislatures try to impose caps, and the lenders hire lawyers and financial engineers to find every single loophole.
We see that playing out state by state. Let's look at Montana, for instance.
Montana made a huge push. They slashed the max APR all the way down to 36% from highs of 400%.
Which effectively killed the product there.
It did. The lenders said they couldn't make a profit, and Montana eventually just voted against allowing them entirely.
But that's not the case everywhere. You look at a state like Illinois.
Illinois tried to pass a similar 36% cap, but the vote failed. It just shows you the incredible lobbying power the industry has.
But then California had some success.
California did. In 2020, they set a 30% cap on loans under $2,500 and also capped loans in that bigger $2,000 to $10,000 range.
And this isn't just a state issue. Federal agencies are struggling too, especially when it comes to military families.
This is a really critical point. There's a federal law, the Military Lending Act, the MLA, specifically to protect service members.
And it caps their APR at 36%.
Right, and it bans loans secured by their vehicles. But the federal agencies, the CFPB and the FTC, have basically admitted they don't have the authority to fully enforce it.
How is that possible? If the law is on the books, how are lenders getting around it?
Through clever product design, they just evade the law. Instead of a traditional title loan, they offer what's called an open-ended credit loan.
Which is structured more like a credit card.
Exactly. And by just changing the name and the structure slightly, they can argue it's not technically covered by the MLA, and they can go right back to charging service members triple-digit APRs.
It's just product engineering for the sole purpose of evasion. And we see a similar thing in Texas with this broker loophole.
Texas is a classic example. The state tried to cap interest rates, so the lenders responded by changing what they called themselves.
They stopped being lenders.
They stopped being direct lenders. They re-registered as loan brokers or a credit services organization, a CSO.
And what does that mean for the borrower?
It means the CSO, the storefront, just arranges the loan from a third party. That third party, the actual lender, complies with the state's low interest rate cap.
But that can't be the whole story.
It's not. The CSO then charges the borrower a massive, often triple-digit broker fee for their service.
So the cost is still there. It's just called a fee instead of interest.
Exactly. For the borrower, the total cost is identical. But on paper, the lender is following the law. It's a brilliant, if, ethically questionable legal move that just shows how hard it is to regulate this industry.
So this deep dive, it really has shown us this razor's edge in personal finance.
Mm-hmm.
On one side, you have people in desperate need of immediate cash. The title loan gives them that. It's fast, it's accessible.
But on the other side, the triple-digit APRs and that balloon payment structure, they create this powerful debt cycle.
A cycle that often ends not in a solution, but in financial entrapment and the loss of the one asset they can't afford to lose.
And what's so fascinating is how the industry justifies this. They argue that they're lending to high-risk borrowers, people already in financial distress.
And that risk justifies the high rates.
That's their argument. But that cycle financial distress justifies high rates, which in turn cause more financial distress. That is the defining characteristic of this whole industry.
Which leads us to a final provocative thought for you to consider as these regulatory battles continue to play out.
Mm-hmm.
Remember that detail we talked about, that the loan amount is only 30 to 50% of the car's auction value, a huge safety cushion for the lender.
Right.
So if regulation eventually succeeds, if states manage to push down the allowable APRs to something sustainable, like that 36% cap,
Yeah.
where does the profit come from then?
That's the question. If the lender can't make money from endless interest payments and rollover fees, will they just start to rely more on that 30 to 50% cushion?
Meaning they rely more on repossession.
Will we see a shift where the title loan becomes less about lending and more about systematic, low-risk asset acquisition, where losing your car isn't the worst-case scenario for the lender, but actually part of the planned business model?
If you take away the interest income, do you accidentally incentivize them to just take the car?
That's the high-stakes question hanging over the entire future of small-dollar credit.